Good evening, everyone. A very warm welcome to the Income Tax Act 2025 Implementation and Changes Vice Versa Income Tax Act 1961, Tax Audit and ITR Filing 2025. This is our first symposium on the newly introduced Income Tax Act 2025 and other issues in income tax and international taxation. We would continue to hold such symposiums every month as the journey of Income Tax Act 2025 continues. I would now like to introduce our speakers, Mr. Vivek Jalan and Mr. Rohit Sharma. Mr. Vivek Jalan is a qualified CA, MBA, qualified LLM, and LLB. He is the partner of Tax Connect Advisory Services and a regular speaker at various professional forums specializing in direct and indirect taxes. Mr. Rohit Sharma is an advocate with more than 15 years of experience in indirect and direct taxes in India. He is a joint partner at Tax Connect Advisory Services. During the session, please put your video and microphone off. If anyone has any query, please feel free to write it in the chat box. We will address all queries at the end of the session. Now, we request Ms. Pranjal Arora from EDUKATING to say a few words. Over to you, Pranjal ma'am.
Hello everyone, a very good evening to all of you. I, Pranjal Arora, on behalf of Educating as well as Tax Connect, welcome you for our today's session. This session is being jointly conducted by Educating and Tax Connect, two platforms that are committed to upskill and update people about the recent and upcoming changes in the taxation domain. Educating is an online platform dispersing diverse services which include e-learning, corporate training and consultancy services in taxation and finance. It also offers various e-learning certification programs. Whereas Tax Connect is a leading professional services firm providing effective and quality solutions in assurance, taxation and advisory services. Tax Connect offers a multifaceted suite of customized businesses, growth in strategic solutions for any sized company in any field or industry. Together, through this collaboration, the idea is to bring the best of both the platforms to you, combining knowledge, expertise, and practical insights that will help each one of us stay updated and grow in our professional journey. Now, I would like to hand over to our experienced speakers. Over to you, sir.
Hello, am I audible?
Yes, sir.
Yes, sir, you're audible.
Yeah. So, thank you, Rajan, and good evening to all the participants. First of all, who have joined on this 12th of September evening. I understand that on 15th of September, you have your ITR filing date for certain taxpayers and assessees. And tax audit is also very, very near, and you might all be burdened. And we were thinking about having this session now, or maybe after 1 week after 15 September deadline is over. But then we decided that no, we should have it now so that you can prepare for the tax audit. And we will discuss on those areas also, as well as interplay on the tax audit and ITR changes which have taken place for assessment year 25-26 tax audit and ITR forms. Thank you to Educating for partnering with Tax Connect. And this is our first such symposium on income tax and international taxation. Every month, or maybe even at a more frequent interval, we will be conducting these symposiums now. You know, Income Tax Act 2025 has already been passed. It is a law of the country today. and it will be implemented from 1st of April 2026. It is very important that we all as tax professionals, whether in industry or whether in the practicing space, we all understand this act, also understand the differences between Income Tax Act 25 and Income Tax Act 1961, so as to implement it effectively. While the CBDT has maintained that this act is a process and an attempt to make the Income Tax Act simpler, and it is right in that way that the act is much simpler. If you read Income Tax Act 2025 and Income Tax Act 61 side by side, you can understand the difference. Even though you may or may not be practicing in income tax, you can still understand the difference. However, we all know that even a comma and a full stop change in an act, specifically of the nature of Income Tax Act, that brings about hours of discussion, may lead to a lot of disputes also, and also lead to many clarifications going forward. So these symposiums, starting with today, and by and large we'll have, as I said, every month, one or maybe more frequent, we will keep on discussing these changes, which as per our analysis over the last 2-3 months, we have been going on reading from the time when the bill came in on the 13th of February 2025. We have been analyzing, keeping the Income Tax Act 25 and Income Tax Act 61 both side by side. We have also represented before the select committee, which have made changes, which have taken cognizance of many suggestions which we have given, right? So we'll discuss all of that slowly and steadily, one by one, so that all the participants here, you can understand that while it is a major attempt for simplification, yet all of you would be required to relearn a lot of new things in the new Income Tax Act 2025. Along with this, we'll also discuss the changes in the current jurisprudence, the new issues, the new case laws which are coming, which will impact most of our assessments, etc. My co-speaker Rohit is here with me, and he would be taking up the ITR and the tax audit changes. We'll be answering questions, so you can keep typing in the chat boxes as we go along, and we'll be answering all the questions at the end of the session. At the end, before starting, I would like to thank Mr. Arun Shajar in absentia, who was instrumental in getting Tax Connect and Educating together on one platform to share this the academic as well as professional knowledge with the taxpayers and the tax professionals at large. So thank you, Arunji, for this initiative of yours. With this, I'll share my screen and yeah. Deepa, is the screen visible?
Yes, sir. The screen is visible.
It is visible, sir.
Yes, sir.
Right. So, as I said, we'll discuss on 4 aspects over here in this symposium over the next 1 hour, 30 minutes, 1 hour, 15 minutes or so. We'll keep last 10 minutes or so for the question and answers. First, to start with, the Income Tax Act 2025 versus Income Tax Act 1961. I think most of us are here to listen to this as well as ITR and tax audit, which are going to come. So we'll start with the Income Tax Act 2025 versus Income Tax Act 1961 differences. All of you would have already gone through various articles, various CBIC publications, which have in detail analyzed on how the word count has reduced, how things have been simplified, how TDS, TCS provisions have been simplified and brought at one place, how non-profit organizations provisions have been brought at one place, etc., etc. Right? So we will not go through all of that once again. We will hit one by one at the differences which we, while reading both the act side by side, and that is how we have made the presentation also. So we'll discuss on our views as to what are the differences. We'll leave thought with you. You know, many of the times what our view is, you might have a counter view, and that is very, very welcome. Do keep typing in your chat boxes if you have a counter view also, because this act is evolving. The evolution has just started, and we'll keep on evolving this act at least for the next 50 years. At least all of the people in this webinar and going forward the webinars, I think in our lifetime, over the next 30-40 years, we would not be seeing another new Income Tax Act. Income Tax Act 2025 would be the act which we would be witnessing, we would be living our professional's life with, right? So this is the start of that 30 to 40 years, and we all may feel ourselves to be lucky to see this huge and mammoth reform, and we would be taking part in this mammoth reform. So the first policy amendment, I would term it as a policy amendment, while you know, in many quarters it has been said that there is no policy amendment, which is right to the extent that there is no impact directly on the tax rates. But tax policy is more about procedural amendments also. Procedures in tax policy, even the Honorable Supreme Court has held this, have to be read along with the substantive law. And that is how the entire tax policy is made. So first procedural amendment, and which we have discussed earlier in our various videos, that is also now out in public domain, while CBDT's press release dated 8th of September 2025. So I'll tell you the little background of this. Before the last budget, that is the last to last budget of July 2024, it was represented from the industry. It was represented by the taxpayers and the tax associations that this TDS returns amendment or rectification of TDS returns, where there was no due date of the rectification of the TDS refund, the TDS returns, that caused a problem with the taxpayers, specifically the deductees. Why? This is because the deductor has got 6 years, 7 years, 10 years to rectify the TDS returns. And in case he rectifies after 4 years, 5 years, and the deductor reduces the amount of TDS deducted, then the deductees returns would be reopened, assessments would be reopened, and the effect would be given, right? So it was represented that there should be a timeline for rectification of TDS and TCS returns and statements. And therefore, the second proviso to section 200 of the current Income Tax Act 61 was introduced by the CBDT and the ministry in the budget of July 2024, which specified that the TDS and TCS returns could be rectified up to a period of 6 years, right? TDS returns could be rectified up to a period of 6 years, right? Now, this 6 years period, which was specified in July 2024, that has been reduced further to 2 years by the Income Tax Act 2025. White section 397 subsection 3 clause F, 397 3F. It specified that the TDS returns can be or TCS returns can be rectified maximum up to 2 years, 2 financial years from the end of the financial year in which the TDS or TCS returns are due. So if you see quarter 4 of financial year 23-24, Q4 FY 23-24 TDS returns due date is May 2024, which will fall due when? Where 2 years, the financial year in which it will fall due will be 24-25. So 2 years from 25 will be 2027, right? March 2027 would be the due date of the rectification of TDS TCS returns for Q4 of 23-24, right? However, come to Q3 of 23-24, the due date would be 15th of January 2024. Financial year end would be 31st of March 2024. 2 years from 31st of March 2024 would be 31st of March 2026. So after 31st of March 2026, the TDS TCS returns before and from Q3 of financial year 23-24 cannot be rectified, and this has been specified in the press release. Therefore, in simple and understandable and one line, if you understand, please rectify all the returns, TDS TCS returns up till Q3 of financial year 23-24 by 31st of March 2026. That is your first deadline in Income Tax Act 2025. The new Income Tax Act 2025. This is now also clear from the CBDT's press release dated 8th of September 2025, right? So this is these are the corresponding section 200 and section 200 of Income Tax Act 1961 and 397 3F of Income Tax Act 2025. This is the extract of them, right? So TDS and TCS provisions, friends, have seen a complete revamp in Income Tax Act 2025. It was represented by all the taxpayers, all, not even one taxpayer left. Whoever have represented, there were, we understand, more than 20,000 suggestions to the CBDT on the Income Tax Act 2025 drafting. And I think all the representations they must have said to revamp TDS, because TDS and TCS provisions were spread across 71 sections in Income Tax Act 1961. So what they have done, you would be now aware that they have consolidated all the TDS TCS provisions in section 393, 394 and 395 of Income Tax Act 2025. Of course, there are other few sections on the returns, etc. But the substantive provisions for tax deduction and collection, tax deduction is in 393, tax collection at source is in 394, and the low TDS deduction certificate, which was there in 197 of Income Tax Act 61, it comes to 395 in Income Tax Act 2025, right? So just to understand a little further, when you read the Income Tax Act 2025, you must have already started reading, but just for your information, for example, so now what you say 194C, that becomes serial number 6 of the first table of section 393 of the Income Tax Act 2025. Clear? So there are 4 tables in section 393. TDS deduction table for residents, for non-residents, where no TDS is deductible, right? So all of these tables are there. So now all these sections 194A, B, C, D, E, all have been merged into tables. So now you will have to talk about the serial number of which table you are referring to when you are referring to tax deduction provisions, right? Similarly, 394 is for TCS. Now 395, already you can see on your screen what I have done over here, what you see in red on your screen, that is the amendment. So now what we are speaking about is the final act. Now this will not be amended at least until the Finance Act 2026. What came out in February 2025 was the Income Tax Bill 2025. We represented, and thereafter the Select Committee in July 2025, it came out with its recommendations. And in August 2025, the Income Tax Act 2025 was passed by the Parliament, right? So what I'm showing you on your screen in red is the amendment already done by the Select Committee, to which the suggestions had gone on the Income Tax Bill 2025, right? So in section 395 of Income Tax Act 2025, it relates to the low TDS deduction certificates, right? It is apropos section 197 of Income Tax Act 1961. Now, it said whatever section 197 says, that a person who wants a low TDS deduction certificate because of no income or insufficient income, he can apply before the respective assessing officer. The assessing officer, if he feels that the person is eligible for low TDS or TCS certificates, he might issue it. However, there were 2 major, so to say, differences which we identified, right? Number 1, if you can see on red on your screen, this section 395 only allowed, that is, I'm talking about the bill, it only allowed for low TDS deduction or TCS certificates, right? It did not allow for nil TDS certificates, right? So what did the income tax bill specify? It specified that the assessing officer may provide a deduction, may provide for deduction of tax at a lower rate. It did not say that the assessing officer can provide for no deduction of income tax at all. Now on your screen, if you see on your screen section 395 subsection 1 clause A, 395 1A, it talks about even no deduction of income tax. So now they have amended this in the final Income Tax Act 25. But if you see section 395 5 on your screen, right? 395(5), it talks about a change in low TDS deduction certificate. So today, in case the assessing officer allows you or allots a low TDS deduction certificate, thereafter, for at least for a period of time, now it is 1 year, he cannot cancel your certificate once allowed, until unless, of course, there is a specific circumstance. However, under 395(5) in the Income Tax Act 2025, they have specified that assessing officer may cancel the certificate granted under subsection 1 or 3 after giving reasonable opportunity to the applicant. So the power is there with the assessing officer to even cancel your certificate within the time period for which the certificate is granted. The time period, of course, would be 1 year. It may be out in the rules. So this is a major change in low TDS deduction certificates under section 395 vis-a-vis Income Tax Act 1961. Now, whenever an act of this gamut changes, repeal and repeal and savings provisions gain a lot of importance. And we have discussed this in our videos. You can go through our Tax Connect YouTube channel. We have discussed this earlier. Even when the bill had come, we discussed this, and the select committee has made one change in this, right? So what repeal and savings provisions is, the entire repeal and saving provision is in section 536 of the Income Tax Act 2025, right? Repeal and savings provisions under section 536, if you see, it provides that whatever rights, obligations, or options or liabilities you have in the Income Tax Act 1961, whatever options you have taken, if you have taken an option of section 115 BAC, that is the new regime of taxation, whatever rights you have, whatever refunds you have, whatever liabilities, payables you have in Income Tax Act 1961, it gets carried forward to the new regime Income Tax Act 2025, right? That is what section 536 by and large says. There are many clauses in 536 too. However, on your screen, you can see only one specific, I'll discuss one specific clause, 536 2J. And this we have discussed even when the bill was introduced in February 2025. What is this? It says that any agreement entered into, appointment made, approval given, recognition granted, circular, direction, instruction, notification, order, rule, or any scheme framed under the provision of the repealed Income Tax Act, that is Income Tax Act 1961, shall, in so far as it is not inconsistent with the corresponding provisions of Income Tax Act 2025, shall prevail. So on your screen, if you see in bold and yellow, you will see the word circular in 536 2J. This was not there earlier in Income Tax Bill 2025. It has been introduced. And if you see our video on our Tax Connect's YouTube channel, in February 2025, we have discussed. At that time, this word circular was not there. It was inserted by the select committee. At that point of time, we have discussed this. So if we only discuss this word circular, right? It was not there earlier, but at that point of time, we had presumed that it would include circular also. And they have introduced this word circular. So what does 536 2J circular word say? It says that any circular in Income Tax Act 1961 that is consistent with the provisions of Income Tax Act 2025, that would prevail in the Income Tax Act 2025 regime, right? Any circular which is consistent with ITA 25 provisions, it will prevail after 1st of April 2026 also. Now, on the other hand, what it would also mean is that any circular which is not consistent with the provisions of ITA 25, that would not prevail after 1st of April 2026. Now, I will give you one example. Now, there was a circular number 12 of 2022, dated June 2022. In that video in February, we have inadvertently said 2021. It is actually June 2022. Circular 12 of 2022 with respect to section 194 capital R TDS. 194R provides that a TDS of 10% would be deductible in case there is any provision of benefit or perquisite subject to certain thresholds and other conditions by one deductor to a resident, right? However, question was, what about post-sale discount? In case post-sale discount is given, then whether through a credit note, then would that be considered as a benefit or a perquisite or not? In this circular, it was stated yes. Even post-sale discount would be considered as a benefit or perquisite and would make them liable to TDS deduction under section 194 capital R. However, a relaxation was provided that post-sale discount or discounts at large would not attract the provisions of section 194R of 10% TDS. Now, come Income Tax Act 2025. 194R is copied and pasted in section 393, right? As it is. No change in 194R of ITA 61 in ITA 625. However, because there is no change in 194R as of now, this circular becomes inconsistent with the current 393. Therefore, because that circular is inconsistent with the present 393, which is apropos 194R of ITA 61, therefore, that circular may not prevail, and therefore, TDS at the rate 10% may be required to be deducted on discounts, post-sale discounts in Income Tax Act 2025 from 1st of April 2026. So what is required, and we understand that possibly the CBDT would bring out and publish a complete exhaustive list of all the circulars which have been issued in the erstwhile regime and which would be considered as consistent with the provisions of Income Tax Act 2025. But then this again is a change which we are seeing in the Income Tax Act 2025 vis-a-vis ITA 61. Now, here is another example, right? And again, as I said, you may have another view on this, right? And all of you are, open to share your views or questions on this platform, and it would add to the more, it would add on to the interest which this session would generate further, because this is a complete new territory which we are entering. We are starting this journey of the next 30 to 40 years now in 2025, right? Now, current section 50, Income Tax Act 1961. What does it state? It states that in case of transfer of any depreciable asset, the capital gain, even on transfer of a long-term capital asset, which is depreciable, would be deemed to be short-term capital gain. Section 50, it has a deeming provision that a depreciable asset, even though may be a long-term capital asset, however, for the purpose of section 50, the gain which would arise on this long-term capital asset would be considered or deemed to be short-term capital gain. Does it change the section 50? Does it deem that the asset itself gets converted into short-term capital asset? No. What it says is that only the gain for the purpose of section 50 would be considered as a short-term capital gain. Now come 54 EC. That requires that any gain, any capital gain on transfer of a long-term capital asset being land or building, if within 6 months it is invested in specified bonds, then the capital gain, subject to the amount of investments, would be proportionately exempt, right? However, for the purpose of section 54 EC, I'll take you to, on your screen, you have 54 EC. It says where capital gain arises from transfer of long-term capital asset being land or building or both, right? And thereafter it is invested in bonds, then it will be exempt. It does not convert the long-term capital gain into short-term capital gain. That is only for the purpose of section 50. It does not convert the long-term capital asset into short-term capital asset. Section 50 also does not convert. So the way it is currently interpreted, and the Bombay High Court in the case of Ace Builders has also held that the deemed short-term gain on the transfer of a depreciable capital, long-term capital asset, if invested as per the provisions of section 54 EC, would continue to attract the exemption under section 54 EC. That is the position in many of the cases it has been taken. However, that position is understood to be changed. Now 54 EC becomes section 85 of Income Tax Act 2025 on your screen. It says that where the SSE has long-term capital gain, it very specifically states that the capital gain for the purpose of section 85 has to be a long-term capital gain. So where the SSE has a long-term capital gain arising from transfer of land or building or both, then only section 85 exemption for investment in the bonds that would prevail, right? So what we understand is this Honorable Bombay High Court's judgment in the case of Ace Builders, that stands negated in this section 85 vis-a-vis section 54 EC of Income Tax Act 1961. But see, as I said, we have to read the provisions with an open mind. Now, what I discussed in 54 EC and 85, that is not favorable to the taxpayer. Now again, rules would come in the winter session of the parliament. Forms would come. We should again see whether the rules provide something, right? Although the rules cannot go against the act. However, it is not that everything is against the taxpayer. So we read with an open mind, and we were doing an analysis for a company wherein the company wanted us to understand whether in the new regime or the old regime for the employees who are very highly paid, professionals in the company, whether the tax liability can be reduced. So a major component of tax saving, so you can say in the current day business environment where traveling, specifically for the very senior employees, traveling has become so very important that the car, the perquisites related to owned car, that is a big burden on the employees, and we were trying to analyze how it stood in Income Tax Act 2025. So on your screen, you can see the explanation to section 17 subsection 2 under Income Tax Act 1961 and clause 17 subsection clause section 17 2E of Income Tax Act 2025. The heading is ITB. Actually, this is a even in the ITB bill it was the same. So now it will be ITA 2025. So the explanation to the current section 72, it says, for removal of doubts, I am reading out. For removal of doubts, it is hereby declared that the use of any vehicle provided by a company or an employer, use of any vehicle provided by a company or employer for journey of the SSE from his residence to his place of work or from office or place of or such place to his residence shall not be regarded as a perquisite, benefit, amenity, etc. So only when the car which is provided to the employee is company owned or employer owned or provided by the employer, then only it won't be considered as a benefit or a amenity or a perquisite in the current ITA 61. However, come to 17(2)(e) of ITA 25. It says clause any expenditure. It does not talk about the vehicle owned by company, provided by employer, etc. It says any expenditure incurred by the employer for use of any vehicle, employer owned, employee owned, for journey by the SSE from his residence to office or other place of work, or from such office or place to his residence. Right? So that would be considered to be tax free. So what we understand now is that whether it is employee owned, employer owned, in case the employee is taking a reimbursement of the petrol, maintenance expenditure of the car, etc. under ITA 2025. Again, this is subject to the rules which would come in the winter session, but what we are analyzing is from the Act itself. So possibly herein we are seeing a difference in our understanding in ITA 2025. Even if the car is owned by the employee, it would be considered as tax-free perquisites. Next. Section 68 and 69, 69A, B, C, D. 68 and 69, family on unexplained money, unexplained investments, not disclosed, not fully disclosed, unexplained assets, etc. They are widely used, right? So section 69, 69A, 69B, that becomes section 103 and 104 of Income Tax Act 2025, right? So current section 69, 69AB becomes 103, 104, right? I'm just very specifically pointing out to 69 and 69AB. So what does 69A say? It says where in any financial year an SSE is found to be the owner of any money, bullion, jewelry or any other valuable article, and such money, bullion, jewelry or valuable article are not recorded in the books of accounts or not adequately recorded, and no explanation is provided by the SSE, or explanation provided is not satisfactory, then such valuable article, money, bullion, jewelry, etc. would be deemed to be the income of such financial year, right? Now, what it talks about is valuable article. It ring fences 69A, it ring fences the article unearthed. And there was a case in the West Bengal media, it was reported, wherein a transporter, what did a transporter do? He transported 100 tons of bauxite, etc. However, it took 100 tons, but reported only 70 tons. So the income tax department, it invoked this section 69A and the corresponding tax under 115 BBE at 78%, the higher rate of tax, considering it to be a valuable article. This bauxite, they said, see, that the transporter has not declared this bauxite 30 metric tons, which was not delivered by it, it would be considered as being with the transporter and undeclared income of the transporter, and therefore it should be offered, it should be taxable under 69A. The Honorable Supreme Court, in the case of D.N. Singh, in this case it held that a valuable article is an article which has a high volume, and so and a valuable article is an article which have a low volume, small article, but high value. It is not an article which has a high volume and a low value. So it is like diamond, which has low volume, high value. Therefore, this bauxite with a high volume, low value cannot be considered as a valuable article. Of course, there were others, ancillary arguments therein. But it says that this is not a valuable article and therefore 69A is erroneously invoked in this case. Now, what they have done under section 104 of the Income Tax Act 2025, they have converted this money, bullion, jewelry and valuable article into asset, unexplained asset. Unexplained money becomes unexplained asset. And asset, they have defined under section 104(2) as asset includes money, bullion, jewelry or valuable article, right? Therefore, it is, of course, again, this is a change which we have seen, and what we feel as of now, as we read section by section, this is a change, and in our view, possibly the Honorable Supreme Court's verdict in the case of D.N. Singh, that may have been negated out here, and now that bauxite may be brought to tax under the new section 104. Now, similarly, look at section 69B on your screen of ITA 2020, ITA 61. It says where in a financial year, an assessee has made investment or is found to be the owner of any bullion, jewelry or valuable article, and the officer finds, now here is the difference, officer finds that the amount expended is not adequately disclosed, then the excess amount may be deemed to be income of the assessee. So if any investment is found to be the office, and if any amount expended on any investment is found to be not adequately disclosed in the books by the officer, then the difference between the amount expended and the amount disclosed, that can be brought to tax under 69B, right? However, what 104 says on your screen, where in any tax year, any asset has been found to be owned or belonging to the assessee, which is not recorded in the books of accounts, if any maintained by the assessee, or the assessee finds out that in yellow on your screen, amount of such asset, they have removed the word expended. Amount of such asset exceeds the amount recorded. So what amount are they talking about? Is it the amount spent, historical value, or is it the current market value? So many of the taxpayers, they have received notices in the last year in December, right? On foreign assets. They did not fill up that foreign assets and FSI, FA and FSI schedule of ITR. And they got the notices from the department that these foreign assets need to be filled up. They filled up afterwards. So now the question is that in case they don't fill up, and in case the department finds out any foreign mutual fund, say for example, what would be brought to tax in the year in which the assessing officer finds out such a investment in an asset, mutual fund, in my example? Would it be the market value or would it be the amount originally expended? So this again, you see, again, this is our analysis. We have understood from what, we are reading. So these are the first glimpses of 5-6 important amendments. There are many, many, many more. We would discuss this in our going forward symposiums. But what it brings us up to is that Income Tax Act 2025 needs to be implemented for the taxpayers, at least for the businesses. The current ITR when you're filing and the current computations which you are doing. And in fact, in the last 2-3 years, whatever positions you have taken as an organization, right, for high net worth individuals, whatever positions you have taken, that need to be reanalyzed from the ITA 25 perspective. On your screen, you can see the heading. Train is ready. Taxpayers take care of the track. So train is ready. Income Tax Act 2025 is there. But track ITBA 2.0 is still under implementation. So this ITBA software, Income Tax Business Analytics software, 3.0 would be unveiled when Income Tax Act 2025 is implemented. That needs to be completely done by 31st of March 2025. So that again is work in progress. How it shapes up needs to be seen. All the returns will change. TDS, TCS returns will change. Income tax returns will change. On 7th of May 2026, when you are paying the challan, the TDS payment when you are making, that has to be done in the new TDS TCS challan, right? 7th of April, you will do in the old challan. You're filing the last TDS returns for ITA 61 in the earlier current TDS TCS forms. 15th of June 2026, when you are making the advance tax payment, it has to be in the new challan, right? In case your ITRs, last ITRs, whether there is any refund, whether there is any tax payable, right? All of this has to be transited. In case there is any carried forward losses, brought forward losses, all of this from your last ITR, that has to be transited in the Income Tax Act 2025. And all of this, nothing will be physical. All of this, nothing manual. All of this would be automated. It will be online. And ITBA 3.0 is still work in process. So friends, that is why, going live, we have to prepare from now. We have to understand the Income Tax Act 2025. That is why we thought not to delay this symposium further. It would be very important to at least create a visibility, and We have analyzed by and large as of now, 100 sections. We have got so many changes by and large. Every section we are seeing there is a change somewhere or the other. So Income Tax Act 2025 needs to be relearned, right, and re-understood, regathered. All the sections need to be re-understood, and most of all, how to implement it in this income tax portal, how the transition brought forward, carry forward losses, transaction, TDS, TCS carried forward, they have to be reported. That has to be seen so that there is no loss to your taxpayers. So this is it from my side on the new Income Tax Act 2025. This has to be dealt with a little slowly. That is why I've gone a little slowly so all of you can understand. My co-speaker Rohit now would take you through the changes in the ITR. A lot of provisions in the ITR, they have changed vis-a-vis the last financial year ITR, right? In tax audit report, the new MSME disclosure, whether interest would be auto-calculated in that clause 22 for 43BH disclosure. What is the impact of the buyback provisions, which is introduced in the budget of July 2024? All of this will be discussed by Rohit. So over to you, Rohit.
Thank you, Vivek sir, and thank you to the team of Educating who is organized this seminar. So just allow me to share my screen. Yeah, Deepa, my screen is visible?
Yeah, visible, Rohit.
Okay. So good evening, participants. Today we will discuss these significant issues for income tax returns and tax audit report. We will also see the interplay between these two documents. We all must be agree that this income tax return and the tax audit report are the tools which is used by the income tax department for the purpose of assessment and for the purpose of appeal proceedings. So it is very important that we file the return as well as the audit report with extreme care. So we will discuss some critical issues and forms which require specific attention at the time of filing. We will start with reporting of TDS, scheduled TDS, where we need to report that what is the amount of TDS deducted during the previous financial year. So previously the table was there. In the assessment year 25-26, a new field, section under which TDS is deducted, has been inserted. In this particular section, you need to provide the section under which the TDS has been deducted so that the income tax department can match the income which is corresponding income reported in respective head of income in your same ITR. So from the assessment year 25-26, this linking of this section under which TDS has been deducted and the income reported is to be done through this scheduled TDS. So this section is to be filled with very care. We will discuss the practical impact of this TDS section also. Now, for example, TDS if deducted under section 194R. So you can see in your form 26AS that one party has deducted TDS under section 194R and it is appearing in your form 26AS. What is 194R? So in case any value of any perquisite or benefit arising from business or exercise of a profession, whether convertible into money or not, or in cash or in kind, or partly in cash and partly in kind. So any value of benefit or perquisite, if you have received, then the person who has given the benefit will deduct TDS under section 194R. For example, if you are a trader of the IT product and the company has organized a scheme that if you purchased a specific amount, for example 10 lakh rupees during the financial year, you will be eligible for a foreign trip for the purpose of sales promotion meeting. Or the company or the manufacturer has given a scheme that a gold coin will be distributed to the dealers and you are one of the dealer. In that case, the person or the company who has given you the benefit will deduct TDS under section 194R on the value to the extent they have given you the benefit in the form of foreign trip or gold coins. Now, this section 28 subsection 4 says that in case you receive such benefit, this will be offered as an income in your income tax return. So at the time of filing TDS schedule, you have to mention 194R in the particular section of TDS, and you have to report this income under the head accordingly in your income tax return. Similarly, nowadays AIS and TIS are available on the income tax portal. In that AIS or TIS, you can see bank interest, dividend income, income from sale of mutual funds, foreign remittance, high value spends, etc. are auto-populated in this AIS or TIS. You have to be very careful and to match this value of AIS with the value of income you are reporting in your income tax return. Next is section 115 BAC. This is regarding opting in or opting out of new tax regime. So previously we know that to opt in or get opt out of this new tax regime, we have to file form 10 IEA if we have the income in the nature of business or profession. Those who do not have any income under the head business or profession, they do not have to file this form separately and they can directly opt in or opt out through the return itself. But for the taxpayers who have income from under the head profit from business or profession, they have to file a separate form if they want to opt in or opt out from new tax regime. And the form is form 10 IEA. Now 115 BAC subsection 6 restrict that in case you have a income under the head business or profession, you can only opt this scheme once. So if you have come out of the regime, you cannot go again in that particular regime. But there is no mechanism applied in the income tax return to trace in case some business or profession income have opted for more than once. The mechanism was not available in ITR to trace that. From the assessment year 25-26 in ITR, the field has been inserted where you need to provide the acknowledgement number and date in which you have filed form 10 IEA, so that they can trace in case you mention at any particular financial year going forward, they can trace whether you have filed previously or not. Or now it can be easily traced from the ITR itself that if someone has opt out more than once or not. Next is section 45(1). We must be aware that from Finance Act 2024, the capital gain has faced a significant changes. So there are two parts of taxation for the purpose of capital gain. First is before 23rd of July 2024 and the second is after 23rd of July 2024. So if you have any income under the head capital gain, whether it may be through sale of capital assets, land and building, or it's from sale of equity shares or mutual fund, you have to segregate that income in two different parts. That is before 23rd of July and second is after 23rd of July. This segregation is required because the tax rate has been changed for these two regimes. That is before 23rd July, the short-term capital gain attracts 15% tax. Long-term capital gain with indexation benefit attracts 20% tax, and without indexation benefit it was 10%. But after 23rd of July, this rate has been changed, and accordingly this short-term capital gain will be 20% instead of 15%. This long-term capital gain is 12.5% with no indexation benefit, and this long-term capital gain under section 112A will be 12%, 12.5% itself. So these rate changes will impact your taxability as well as your computation of advance tax. In the return itself, a quarter-wise and date-wise segregation has been provided, where you need to provide and compute the income and the tax on capital gain part. So very carefully this detail is to be provided so that a correct tax can be computed by the system and there is no risk of any scrutiny going forward.
Now here, Rohit, I have one point. Now, if there is a grandfathering in this, if the property, land or building, say that has been purchased before 23rd of July 2024 for rupees 1 crore, okay?
Yes.
Now, after it has been sold, say on 23rd August 2024, right? At 1 crore 5 lakh rupees. However, now there is a grandfathering that there is an option of indexation available for such properties. Now the question is what I see over here, that in case, say the indexed cost of acquisition for the property on the date of sale, that is 23rd August 2024 is 1 crore 10 lakh rupees, right? And sale value is 1 crore 5 lakh. If you go into 12.5% long-term capital gain, of course, then there is a 12.5% tax on 5 lakh, right? 1 crore 5 minus 1 crore. However, in case you go for indexation, then there is a loss, long-term capital loss of 5 lakh. 1 crore 5 lakh minus 1 crore 10 lakh, indexed cost of acquisition. Whether the ITR will allow you to carry forward this long-term capital loss by taking the benefit of indexation option.
So in ITR, there is no specific column has been provided to carry forward such loss. So it is clear from the intent of the government that no such loss can be carried forward, sir. It is my understanding.
Right. So that is very critical.
Right.
I think the loss cannot be carried forward. For the purpose of the gain, you can take that option.
Correct. Next issue, which Vivek sir was also discussing during the discussion of ITA 2025, this buyback part. In case of buyback of shares by a company, previously before changes, until 30th of September, this in case there is any buyback, the income is taxable in the hand of company, and the recipient who is receiving the buyback part, he is not liable to pay any tax. But with effect from October 2024, the Finance Act 2024 has amended the law, and the entire consideration received by shareholder on the buyback of shares will be taxable in the hand of shareholder only under section 222F in the form of deemed dividend. Now, this reporting of buyback and reporting of dividend income, we will see how this is to be reported in income tax return. So in your screen, if you will see, if the buyback has been received, in schedule OS at the bottom side of screen, if you see schedule OS, that is income from other sources, a specific field has been provided to report such deemed dividend under section 2 subsection 22 clause F in clause number 1A3 dividend income under section 222F. So the entire consideration received in the form of buyback is to be reported in this section in schedule OS. Now, since you bought the shares at a particular price, they may be cost of acquisition around suppose 5,000 rupees, and at the time of buyback you have received a particular amount. For example, you have received 50% against the buyback for 2,500 rupees. Now that 2,500 rupees which you have received is to be reported as deemed dividend in clause OS, and you have buy the shares at the cost of rupees 2,000 rupees. That deduction is not available under income from other sources, but that cost of acquisition is required to be reported under the schedule CG capital gain. On the basis of the period of holding, it may be short-term capital gain or long-term capital gain. In both the schedules, both the sections, the option for reporting this capital loss on buyback shares is available. So I have taken this screenshot from the income tax return itself. For in short-term capital loss or long-term capital loss, you can report the cost of acquisition of that particular shares. This is very crucial because income, if you offer the tax, you take benefit of this capital loss. If this gets set off the current year, it is fine. If not, you can carry forward it to subsequent years so that in future this loss can be set off with your capital gain income. So this buyback reporting is very crucial, which is newly inserted in ITR of assessment year 25-26. Now, there are some more impact. We have to report this dividend and this should match with scheduled capital gain. Since there is no consideration required to be reported in capital gain, only loss amount required to be reported. Corresponding reporting of this buyback received is required to be done in clause 36B of the tax audit report in form 3CD. So I would like to bring you to that particular slide, form clause 36B, where this reporting of buyback is required. Yeah. So this new clause 36B has been inserted in form 3CD in the tax audit report, where you have to report the amount received on buyback and the cost of acquisition of shares bought back. So buyback of shares under section 115QA, this newly requirement is inserted in tax audit report also. So initially we were discussing that the value which has been reported in income tax return as well as in tax audit report, if some value required reporting at both the places, they should match with each other. So in case such dividend income or buyback amount has been reported in ITR, the corresponding amount should match with clause 36B of tax audit report. So this linking is very important. Next, there are cases where exemption or deduction has been claimed for disability expenditure under section 80DD or section 80U. Previously, we already know that in case of expenditure incurred for disability or severe disability, form 10IA has been issued by the medical institutions and all. They issue form 10IA for autism, cerebral palsy, multiple disabilities, etc. But for other type of disability, there is no provision to issue form 10IA. So in that case, they issue a disability certificate. In the ITR, the option to report disability certificate was not there previously. This has been inserted newly in Schedule 80DD and Schedule 80U. In both these schedules, you can see the yellow highlighted part on your screen. Acknowledgement number of form as per Rule 11A2, that is the certificate which has been issued by the medical institution, but not the 10IA, because beside there is a separate field for 10IA is given. So either you have 10IA or you have any disability certificate. Any of them if you have to report that acknowledgement number of that particular form or certificate here. Now we understand that this detailed reporting has been implemented to restrict any unauthenticated expenditure claim which has been reported and which has been faced by the income tax department, and that has, for restricting these expenses, this reporting has been implemented. In ITR 2 and 3, if you have income more than 1 crore rupees, you have to report assets and liabilities. This reporting will help you at the time of scrutiny. In details, if you have income under the head salary, you have to report disclosure for HRA deduction if you are claiming. But if you are claiming deduction under HRA, you have to report place of work, actual HRA received, actual rent paid, basic salary and DA, 50 or 40% deduction on the basis of city where you are located. These details are to be recorded in very detail, and only while reporting a particular figure will not allow you to claim the deduction. Now in this case of HRA, yes sir.
Yeah, I have a point here, Rohit, that in this HRA and all these, there are a lot of notices. I think more than 40,000 notices have gone, and already income tax department is also sensitized for non-reporting or misreporting of the deductions, etc. They have introduced this new thing in place of work, okay, for HRA 1013A. Now say for example, a person, he has shifted from Hyderabad to Delhi for work, okay, but his family is still in Hyderabad in a rented premises. In Delhi he stays, say, in a bachelor accommodation, and to his Delhi employer he gives the rent receipt of Hyderabad, right? That is allowed. However, in the place of work he mentions Delhi in his ITR. So again, this might create a problem here, because the rent receipt which is attached, that does not match with the place of work.
But I understand that he is eligible for deduction for this HRA. Even in this case, yes, he may receive a notice or any notice for scrutiny that there is a mismatch, which can be explained.
Right.
Yes. Further, in case there is a change in employer or any place of work during the year. So suppose for April to September you are located in Kolkata, and for October to March you were located in Delhi. So during the same financial year you were located in two different places. Now it is to be seen that place of work is to be reported how. Secondly, if one is metro city and second is if other than metro city, then this 40% or 50% calculation is to be done separately for that, because only one table is been provided for HRA claim. So this computation has been done separately by the taxpayer. In case of you are claiming any deduction for home loan, either under section 24B under the income from house property, or under section 80EE or EE, you have to provide all the details like name of loan giver, account number, date of sanction, amount of loan, closing balance or interest amount. These details has been introduced from AY 25-26 itself. Now these details has been asked by the department, which we understand that they will cross verify the details which has been reported by you vis-a-vis the detail available with the cross part. Like if you have reporting that we have taken a loan from any bank, department has access and has authority to verify that actually you have taken any loan or not. If you have reporting that you have taken any unsecured loan from any individual, department will verify from the PAN that whether that individual is reported in his income tax return any interest from such loan or any income in this respect. So this cross verification can be easily done, and that's why this detailed reporting is required. Similarly, under section 80C, you can claim various type of deduction, but yes, if you are claiming deduction for insurance, PF, etc., you have to provide document or receipt number, account number, insurance policy number, etc. Similarly, reporting in 80D is also required, name of insurance company, policy or document number. If you are claiming deduction for treatment of specified disease, you have to specify name of that disease and you have to provide further details regarding that disease. Then only you will be eligible to claim the deduction. For education loan or loan for electric vehicle, all the details like name, account number, loan, date of loan sanction, etc. will be required. So only putting the figure in a return will not allow you to claim the deduction. This is very clear by the income tax department. If you are having any cryptocurrency or any foreign asset, that is to be required reported in schedule VDA, and there are notices has been issued by the income tax department for not reporting such virtual digital assets, and that's why we recommend you report this transaction definitely in your ITR. What are the details required? That is acquisition and sale date, cost and sale price, if any TDS has been deducted, or exchange or wallet used to acquire this foreign asset. Some relief has been provided for presumptive taxation. For business turnover, limit has been increased from 2 crore to 3 crore. For professional receipt, it has been increased to 75 lakh, which was previously 50 lakh. And in case you have cash receipt more than 5%, then you cannot go for presumptive taxation. And applicable 6% or 8% business income you need to declare to avail this presumptive taxation scheme, where you need not to maintain books of accounts or you need not to get your accounts audited. In addition to the points which we have discussed, there are other changes in ITR 1, 2, 3, 5, 6 and 7. Especially in this section ITR 7, this FCRA registration has been made mandatory. Breakup of expenses related to religious or charitable purpose has been required. This has been into two different categories. First is in India and second in outside India. Next is separate schedule also has been provided for utilization of corporate funds and loans. If you are claiming exemption, you have to provide specific section. It is either 1023C, section 11, 12A, 13A, etc. You have to provide in very detail. Further, if you are filing any form 10 or form 9A, this should be matched with your exemption reported in your return with the detail of accumulation or deemed application which you have reported in your ITR. So ITR 7, there are various changes. In ITR 3, 4, 5, 6, only new field has been inserted for cash received from business or profession. For ITR 1 or 2, we have already discussed. Now we will move to tax audit. This clause 21A has been inserted. We have to newly report to expenditure incurred to settle or compound offences under any law. So in case any amount has been paid and claimed expenditure in your books of accounts for settlement or compounding of offence. Now we are taking some examples like custom penalties or GST law. There are some penalty provisions under section 73, 74, section 122 where general penalty is there, section 129 where penalty for vehicle detention is required to be paid. These are the penalties which can be considered as penalty paid for compounding of offences, and this may be required in clause 21A. So there is an interlinking between GST law vis-a-vis income tax audit report, which where you need to take care. Any expenditure which has been disallowed under section 37(1)(4), that can also be reported in clause 21A. Clause 22, disclosure for payment to micro and small enterprises. Section 43BH is saying that if you are not paying any micro and small enterprises within the limit prescribed in section 15 of MSMED Act, then the deduction will be not allowed in that particular year, and you can claim the deduction in the year that amount is actually paid. Clause 22 has been provided to track this compliance of section 43BH, where you need to provide amount of interest which is accrued, whether paid or not. Even if it is accrued, you have to require in clause 1. Total amount required to be paid to micro small enterprise is to be reported in clause 2, serial number 2 of clause 22. Now third category have two different sections. Whether you have paid up to time given under section 15, that is 15 or 45 days, you have to report it in section A. And if not paid up to time given, then you have to report in table number, clause number B. So if you see clause 22 on your screen, the point Roman number 1, where you have to report the amount of interest, and point number 3B, where you have to pay the amount which has not paid as per the terms of section 15 of MSMED Act. This amount should proportionally match with each other. It cannot be the case that amount of interest is only 5,000 rupees and the value reported in clause 3B is 5 crore rupees. This is not matching proportionally. So these two figures should match with proportionately each other, and this corresponding disallowance will require to be reported in your income tax return. So at the time of audit, you can give your auditor the opening balance of creditor, the list of creditor who are not registered under micro small enterprise, any declaration if received from the micro and small enterprises that they are waiving this interest part, even if the payment has been made after the prescribed date. This certificate or the declaration can be uploaded by the auditor to report the value in clause 22 in form 3CD. They can report this declaration in support that even if it is paid, the interest is not payable, and this has been waived off by the party itself, this micro and small enterprise itself. So this reporting is very critical, clause 22. Next is
Rohit,
clause
2
31.
minutes.
Sure, sir. Clause 31, where you required to report loans or deposits. If it is more than 20,000 rupees, specific reporting with specific code has been required. We have listed out the codes. There are 12 different codes which you need to segregate your transaction, whether this is a case of loan received or this is a case of loan paid. If it is more than 20,000 rupees or 2 lakh rupees if for agriculture societies, then you have to required in clause 31 of form 3CD. For clause 36B, we have already discussed. At the time of filing form 3CD, you can do some reconciliation, like clause 44 can be reconciled with GSTR 2B. You can prepare a ledger-wise loan register where you can track this amount has been paid more than 20,000 rupees or not for in cash. MSME vendor analysis you can do, whether they have valid certificate Udyam registration or not. Clause 19, 22 and 26 can be matched with income tax return, ESR schedule, BP schedule and schedule 43B. If there are any journal entries involving loans, that is required to be reported in clause 31. So these are the specific reconciliation, interlinking to be done when you are filing this income tax return as well as this tax audit report. So this is it from my side. Thank you very much for your patience hearing. Over to you, Vivek sir.
Yeah, so thank you, Rohit. Although I can see no questions in the chat box, right, Ms. Pranjal?
So I think there was one question in the chat box.
Is it?
So yes, I think there was one question in the chat box.
Hello, Vivek sir. Hello, Rohit ji. I am Pooja Garg from Educating.
Yeah, hi, Pooja.
Yeah, hi, Pooja ji.
Yeah, hi. So, yeah, there is a question related to Section 80U. Is deduction for severe permanent disability under Section 80U is allowable under new regime? Please advise.
No, this deduction is allowed only under old regime, not allowed under new regime.
And one person has asked to share the PPT, Ms. Jaya Lakshmi.
Sure. I can see one more query. What is the correct tax rate to be deducted by a tenant of residential property on a monthly rent of rupees 2 lakhs? So the rate of TDS will be 10% under section 194I.
Where is the query? I can't see it on my chat box. Is
Mr.
it in-
Jairam Raju has posted this query, sir.
It is in the message section.
Okay. So possibly there is some, in my section, it is showing decrypting content. Achha,
Okay.
it is not decrypted. Somehow there is some issue over here. Fine. So I think we have all the three queries have been answered nonetheless.
Right.
So I think we can conclude the session now.
Yeah. Over to
Yes.
you.
Yeah. So everyone, on behalf of Educating and Tax Connect, I would like to extend our heartfelt gratitude to all the participants for taking out time amidst of their busy schedule in the ongoing TR and tax audit season. And a special thanks to our speakers, Vivek sir and Rohit sir, for their valuable insights on the newly introduced Income Tax Act, and for Rohit sir for his insights on the changes in tax audit in the ITR forms. And I'm pretty sure that it is going to help a lot of participants who have joined this session today. Once again, thank you everyone for being here with us today. Wishing you a very good evening ahead. Thank you.
Thank you very much.
Thank you, Pranjal. Thank you,
Thank you, sir.
Educating. Thank you.
Thank you, sir. Thank you so much for taking this wonderful session with our collaboration, and it was really insightful, especially regarding the new ITR form and the tax audit report, which is the need of the time. Thank you so much.
Thank you, Pooja. Thank you.
Thank you, Pooja ji.
Good night, everyone.
Pooja, I would like to thank Vivek sir and Rohit sir for this wonderful deliberation. Thank you, Educating team, for coordinating this session with us. Thank you to all the participants for attending the webinar. We conduct such webinars every month, and we hope to see you in the upcoming webinars as well. We will shortly share the PPT and video link to all the participants. Thank you all once again.